What if you could build tax-free wealth through property investing? Hi, I'm Jared Krause. I'm the co-host of the Property Pals Australia podcast with Sam Powell. And in this podcast episode, Sam, myself, and Andy G talk about buying property in a self-managed super fund. We run through the top 3 risks of buying property in a self-managed super fund. We talk about the costs of getting a self-managed super fund started, the costs of running a self-managed super fund, and then we also talk about the benefits of buying a property in a self-managed super fund. We talk about how hard it can be to get finance for buying a property in your super fund, the nuances of it. We talk about, can you have an offset account attached? And what are the regulations like with lending for self-managed super fund that you need to know. We also talk about what sort of property should you buy in your self-managed super fund. Should you start with residential? Could you buy commercial? What does that look like for business owners? There's so much value in this podcast episode on super funds, buying property in your super funds, how you can do it, what to look out for, and what the benefits can be as well. Let's dive in. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. All right, guys, self-managed super funds. I don't know enough about it. I know a little bit, but not enough. And let's talk about it, Andy. Like, so many people want to build a property portfolio in their own name and outside of super in different entities, but may not know they can actually buy in a self-managed super fund. So what do you need to do this to get in to buy a property in a self-managed super fund? I guess my first question is, how much money do you need? Because that's going to be a good one for like moving into borrowing capacity. It's probably going to be a big chat, this one, I
think. So look, ASIC's got rules around what they want to see as a minimum. They usually say around 200 to 250,000 is what they want to see as a balance first before moving into a self-managed super fund. But that doesn't have to be the case.
Rules are made to be broken.
It's not a hard rule. So it's just more guidance. Yeah. And we've seen clients go through with a lot less, like around 130 to 150. I've seen clients pull this off. And it all comes down to your risk profile, because the less money that's there, the more risk there is with that first property, and just cash flow and things like that. But yeah, the general rule, we'll start chatting to clients around that 200, 250 mark.
Mm-hmm. Yeah. Okay. So I've heard the same as well. And then I'm like, hang on, like I've got enough like in my thing for a deposit. Like, can I get it? Can't I just go away and do it? But there's more to it than just like, hey, you've got enough for a deposit. There's also things like your LVR needs to be a certain rate, and then also you've got entry costs and things to consider when starting a self-managed super, and then also I guess management of it. So should we talk a little bit to that?
Yeah, definitely. Look, there's a lot more restrictions and rules and everything that come into play here, as opposed to buying a property in your name compared to a self-managed super fund. So a lot of the stuff's done the same way, but there's just different rules and everything that apply to how you can do it. So the rule of thumb used to be a 30% deposit. And the whole banking space really shrunk for who was offering self-managed super fund loans. It used to be a lot of players in that space, and then it shrunk probably down to maybe 4 lenders that was it. And that was the worst. And now over the last sort of 5 years or so, lenders have started entering that space again. So now we are getting more options, and they are being a bit more creative with the products they offer as well. So you can get deposits and around 20% now. They are allowing that. There
So
are other rules.
80% LVR.
Yep, 80% LVR. There are also rules around how much of a balance you need to have. Some banks do want to see a certain balance there beforehand,
Okay.
but some want you to retain a certain percentage of your initial balance after the transaction's done. So what that means is they might say, okay, after the transaction and everything happens, we want you to retain at least 10% of your initial balance. So if you had 200,000 as your starting balance, you bought a property, they'd want you to have at least $20,000 in cash in the fund at all times. And the main reason they have that is to try and mitigate risk. If things do pop up and there are expenses for the property, you are able to pay for that and not be caught out, or even if something happens and just to meet repayments as well. So there are a lot more rules to abide by with this.
I think that's a good rule to abide by anyway.
Yeah. Well, the biggest risk I see is usually liquidity risk for self-managed super funds, because the way they get treated is your contributions as well as the income that the property generates are going to be everything that keeps this going. So we've got limits and restrictions on how much we're allowed to contribute into our super funds per year. So if you're hitting those caps and you can't put any extra cash into the super fund, then you're gonna come undone and you're gonna have cash flow issues.
Can you run through those caps, those superannuation contributions?
Yeah, so it changes. It changes every year. It's going up, down, up, down. Concessional caps this year, 27,500. But previous years, it was 25,000, then 27,000, and it's just kind of gone up and down, up and down. I think it might have been as low as 22 and a half maybe at one point. But you do have special rules around what you can carry forward over the previous 5 years. So if you haven't been hitting your cap every year for the last 5 years, you can actually jump onto your MyGov or the ATO portal and see how much cap space you've got available. And you're allowed to bring that previous 5 years of cap space forward into a future year.
That is an amazing accounting little hack for myself where I'm like, and other people may be thinking, all right, I want to buy, especially listening to this podcast, I want to buy as much, contribute to my own personal property investments through, my personal income after paying tax, and of course, before I start building my self-managed super fund. And that's what I've made a decision to do, is like not put as much into my super. I still do to bring it down to tax things and stuff like that. But that's really good to note as a strategy of like, oh, I can load more. Are you saying, for example, if 1 year I don't put 20, I put like, let's just say I put 10 grand in over the next 3 years into super. That means technically if it's 25 grand a year for those 3 years, I'm putting 30 grand in where I could have put 75 grand in.
Yeah.
So I can put the rest in at another time, or
you would be able to put 45 concessionally in as a contribution,
cool.
and then not breach any rules or have to pay any extra tax to the ATO. Yeah, so that's over a 5 year period. So yeah, when you're talking about these calculations, it's always easier just to say flat 25 for those examples.
Yeah.
But,
yeah, especially for my brain, because we already spoke about this before. I'm not the best at maths explanation.
So and like you were just touching on a bit, there is a fine line to walk around.
Big part.
Working out if this is something that you want to do early on, especially
a lot of people go
especially
in
for younger
thinking,
clients.
hey, there's we can manufacture
you talk to young clients about putting money into super, and none of them really want to do it.
Just like you
at least not off the bat, because it's something they can't touch for such a long time. They don't want to lock that away. Maybe they've got other goals of a home deposit and things like that. The money could be better utilized. But the effects of compounding and everything like that, you start salary sacrificing or putting money into super at 20, by the time you're 60 and you're able to access it tax free, like that's
Andy would be able to shed a bit more light on that as well.
Next level compounding effect there. So if property is something that you want to do in the self-managed super fund, then putting those contributions away early can definitely help get there.
Yeah, the way I think about it is, if I buy two properties over a 3-year period, or somebody buys two properties over a 3-year period, and then they grow and they earn a bit of income and they're positively geared, then that gets put to your taxable income, but you could instead of paying more tax on the income, you could take a bit out and then put it into your super, and you have a tax sort of strategy around that, I guess.
Yeah.
So there's some pros there in super without even yet investing in a property within the super fund. I wanted to speak to, before we move into the pros and cons of doing this whole build a portfolio in your super, what are some of like the costs, or maybe, I know every single accountant's different, right? But like, what are some average costs of setup, and then what are some average costs of maintenance? Because if somebody does have 130K and they can do it, like, they should know like what some of the costs are getting involved with.
Yeah. Well, and this is part of why ASIC's guidance is around that 200 to 250,000. Is because the fees to open a super fund and to maintain it, especially in the first year when you put it all together in that first 12 months, to set up a super fund just on its own with nothing, not expecting to get a property or anything like that, it's usually between, say, 2.5 and maybe $3,000 to set up the self-managed super fund. And then if you're going to go down property routes, there's a few other things that you need to do as well, which we'll chat about, which can add another sort of 1,000 maybe to it.
Yeah.
And then ongoing costs, because with the self-managed super fund, it's in the title, it's self-managed, so you've got to do it all yourself. So what you need to do as far as compliance is, tax returns annually, financials, and you need to get it audited independently. So that goes out to someone else. And then those costs all vary. Usually it's based on the complexity of the fund. If you've just got a self-managed super fund, and all you've got is a share portfolio and that's it, then, that compliance burden might be a bit less for the accountant, so they might charge you a bit less. I've seen usually it starts at maybe around 1,500 for your more basic super funds. Yeah, per year.
Yeah.
And that might be for tax, financials, and audit all bundled in.
Yeah.
And then the higher end, I've seen as much as $5,000 or more. So when you start, adding complexity, you add a property, you got share portfolio, one property, maybe two properties, term deposits, all sorts of stuff going on, then they start charging you, a lot more for that. Okay. So it can vary quite a lot. On average, it's usually maybe around 3,000 per year.
Yeah. So 3,000 per year for management, and then roughly entry costs is what, like a couple of grand?
Yeah, I'd probably say, if you're just trying to get some rough ideas, probably around 3 as well.
Okay, great.
Yeah, plus GST. So, and that's why when you take that as a percentage of your whole fund, especially if you've only got 150,000 or less, that's a pretty big percentage in fees that you're paying straight away. And then that's what ASIC are trying to, help people with, is not losing so much in fees to get set up. The problem you do have is when you stay on a retail or an industry fund, is you're on a platform, and those platforms usually charge a percentage fee. So those fees increase as your balance increases. And there's usually a tipping point where once your balance is at a certain point, the super fund may be charging you $6,000 or $7,000 a year in fees. So then it ends up actually being cheaper for you to move across to a self-managed super fund, even if you're not buying property.
Yeah.
And in some cases, it's cheaper doing it that way. So,
is that where that 250,000 in your mind comes from? Like when you hit that threshold?
Yeah, it depends on the super fund, to be honest, for that 250,000. Because we just had some clients in here the other day, and going through super funds and the way they hide fees and everything is still shocking. What you look on your statement and what you actually see, what you see they're charging you, or what they tell you they're charging you, and then when you dig a little bit deeper into the PDSs of the investments and things like that, you find out what they're actually charging you, and it's phenomenal. So we had some clients that were around, might have been around 400,000 was their super, and with their fund and their investments, it might have been around the 350 mark. That was a tipping point for them, where it was a bit cheaper to move to a self-managed super fund.
Yeah,
that's a really good question. Yeah.
It's not surprising, put it that way.
Yeah, they've still got a lot to go with disclosure and stuff like that in the superannuation industry.
Do
Yeah,
you
I wanted
commonly
to.
see the, like, say, property purchased through self-managed? Is it more of the commercial route, or is there sort of residential as a priority?
Um, I generally see both pretty evenly. For us, we're probably skewed a bit more towards commercial, mainly because we've got business clients.
Yeah.
So yeah, you can have residential or commercial. There is a good thing. So when you have a residential property, it needs to be treated at arm's length, meaning if I buy this property in my self-managed super fund, I'm not allowed to go live in it or put my partner or family member or something in there. Needs to be at arm's length, and that lease needs to be with someone who's not a relative or connected to the self-managed super fund itself. So there is an exception for commercial property. You're allowed to put your business into that commercial property.
Mm.
That's allowed. So we see a lot of our clients, instead of renting a property or maybe they want to buy a commercial property in their actual company, they'll instead go down the route of starting a self-managed super fund, buy it in their fund, and then put their own business in that commercial property.
Yeah, that's a really strategic play for a lot of people. And you become your own tenant, you're a bit more in control, and it de-risks it if you have confidence around your business, which is a
Yeah,
smart.
absolutely. Everything obviously still needs to be done at market rates and that,
Yes.
but it's just another good way of getting money out of your company into your own pocket, really. And you help funding your retirement and speeding that whole process up. You're building an asset, you're building more, getting more contributions into your fund. The commercial side and putting your own company in there is just win-win.
Yeah, and I mean, we're on self-managed super, but there's a lot to touch base on maybe another time as well, just around like your retirement strategies too. So I imagine on your end, the self-managed super is it a critical part to helping people in that journey of retirement strategies?
For us, it is. Yeah, I see it all the time with our retirement clients. This is just outside of super. So outside of properties in super, but just super as a whole. The clients who have a substantial amount to the ones who have maybe even just a couple 100,000, there's such a huge difference in the quality of life that they can live in retirement and onwards. That it's just when you see the numbers, it's really shocking. So getting clients into to buy into super and wanting to invest in it and find other ways that they can actually engage with their super fund and and buy properties through it, invest in it, and just be a little bit more on the ball, especially the younger they are, just is going to help.
I want to stick with a thread of going through getting somebody started, right? Like you said, you want to help people retire. And you can use your super for that. So somebody starting out that you say is typically younger and they don't want to put too much into their there he goes again. They don't want to put too much into their super because they want to invest outside of super, hence like me. What are some of these, like, how would somebody get started? Would you suggest they do get started with maybe get up to 150 grand or a bit more and then get into like a residential property, using property to grow your super?
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk?
Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypals.au/coaching. That's propertypals.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too.
So getting started is always going to be a big conversation. Most of the funds we see, I don't see a lot of people doing it on their own. you're allowed to have, it used to be 4 members, but now they've changed the rules. You're allowed to have 6 members in a self-managed super fund. Don't need to be relatives as well. So you've got 6 people, potentially 6 people. You can pull all of your contributions, all of your super balances together. So you can see straight away, you got a few people in their 30s who have been working, since their late teens or whatever. You're going to hit those minimum requirements straight away for balances and things like that. So, majority of the funds I see, it's usually a couple who decide to start a self-managed super fund, or business partners, or just a family unit. So mum, dad, and maybe a couple of kids starting a self-managed super fund together. So you usually all starts with that conversation of, the parents would have a bigger fund than the kids. You all want to help out and everyone wants to work together and grow this nest egg together. You can put all your funds towards that goal.
Yeah. Okay. So what does that look like in terms of, say, there's 2 parents and 2 kids, and the 2 kids have 100K in their super each, and the parents might have a bit more. What does this what does that look like? Or let's just maybe stick with 2 couples if it's a more easier example. Like, how does it work?
So what happens is you need to establish a trustee. So a super fund is essentially a trust, and it's held in and superannuation is just a tax structure. And your super fund is just a trust that holds all of your funds in trust for you for retirement. So what needs to happen is you have to establish a trustee for the self-managed super fund. So that's just getting everyone together who wants to be in it and just signing the paperwork. This is how it's going to be structured. All the members have to be trustees for the fund as well. So you can either do individual trustees, and this kind of takes us back to our previous conversation about trusts and how trusts are structured.
Yeah.
So you can have all the members as trustees individually. So then just say there was 4 members, you'd have 4 trustees. Or you can have a corporate trustee, and all the members need to be directors of that company. That way, all the members have equal right and ability to actually contribute and make decisions and do everything that affects their retirement. So you normally go to your accountant or financial planner, set up the trust deed, and then set up a investment strategy as well, which is essentially saying, this is our fund, this is our asset allocation for how much money we want to spend on different asset classes. So are we able to spend, 50% of the balance on direct property, or, maybe 50% or 20% on shares, how much we want to hold in cash? And you kind of establish all those rules from the get-go of how you want everything to be invested. So that's kind of your first big step. So establishing those entities. And then usually the accountant or financial planner can set everything up for you. And then once that is set up, so that will just look like a piece of paper just sitting on your table. You then roll all of your funds, or you set up a bank account using everything that's been set up so far, ABN, TFN, and everything. Set up a bank account, and then you essentially just roll your current super funds into that bank account, and then that's it. You've started.
Yeah, that's another really key point I just want to come back to is the strategy going through with your accountant and your financial planner if you're going down that self-managed super fund route. I mean, a lot of people come to go the buyer's agent route, and they want to buy a property in their self-managed super fund, but they don't have a strategy from their self-managed super position. I always push for people to have that strategy session with their accountant and financial advisors prior to even looking at purchasing a property. So,
yeah, this is the part with the way the rules are at the moment. Accountants can only talk about so much. Financial planners can only talk about so much. You really need to have, so many different conversations there, because the accountant's not allowed to advise you on what the strategy is going to be for, like, the investment strategy is going to be. The financial planner is not allowed to advise you on, other things here and there, and the broker can only talk about so much and can't talk about tax. And
accountant, financial planner, and a mortgage broker.
Yeah, if only there's only one place you could go.
Yeah, Andy, that's awesome. It's interesting like, say you've got two different people that want to start a self-managed super together. What if they've got different levels of funds that they want to put into the super, or would they just only decide to, if they were going 50-50, just decide to contribute the same amount as each other?
So what would happen is if you put all of your funds in, say one's got 100,000, one's got 200,000, everything's tracked, rollover benefit statements. You've got to keep good records with everything that's going on. The benefit statements just show who's contributed what into the self-managed super fund, and what those funds are actually made of. So what's taxable, what's tax-free as far as the components of those contributions. And that just means, what funds have already paid tax at marginal tax rates and what's been paying tax at concessional tax rates. That all gets tracked when you do your financials and tax returns each year. The accountants are tracking, what contributions are being made, what contributions were made at the start. And you get a statement that actually tells you of that total balance, how much each person has within that fund. And that gets tracked each year as you go. So, you might start with 200,000 and 100,000. And then 20 years down the line, let's just say you've got, 3 million in your bank account, or in your self-managed super funds bank account.
Yeah.
That split you'll be tracking over the years, and you know exactly how much someone's contributed by the end of the life of that super fund.
Yeah. So say it was like the same level of contributions with the same, just one person's got 200, another person puts 100 in at the start, that's 300K, and it goes 10x in however many decades.
Mm-hmm.
Would that roughly be, say everything stayed equivalent, would it roughly be like 2 million to one person?
Yeah, more or less. Yeah. Generally speaking, that's
exact, but yeah.
Yeah, because a lot of things top and change and that. But yeah, if, like you're saying, if everything just stayed the same throughout the life of it, that's more or less how it would be treated. Yeah.
Cool.
What would you say would be the biggest risks in going down the self-managed super fund route from an investment perspective for property?
From an investment perspective, I've touched on it before. Liquidity risk is the big one. Just running out of cash, not being able to put more cash towards it. You've got a property outside in your personal name that needs repairs and all these other things. That's easy enough. You can just pay for that and you're done and dusted. So the big risk there, is not having money to pay for things. The other big one, which comes up all the time, and is probably the biggest risk, to be honest, is just the legislation risk, because every time there's an election or something's happening, superannuation comes back onto the table. So, there is an incentive for the government, a pretty big incentive, to have people fund their own retirements, because, their bill for funding pensions and everything like that is huge. So they do want people to self-fund in retirement, but they also use super as a weapon to get votes. So they're chopping and changing the laws all the time. Like, there hasn't been 1 year where nothing has changed, like nothing's not changed.
It's such a tricky one to think about. Like, if you're 30 and you're like, all right, I'm going to just really go and start trying to do some self-managed super stuff and build out that, right? Really focus on it. And you decide to contribute more through, your 30s, 40s, than maybe in your 50s and your 60s. And then you get to a position where, like, I want to retire at like 60 or 65 and pull that money out. And they go, oh, hang on, it's an extra 10 years now. Like, there's a big risk there. It's a massive risk for people to consider, right?
Yeah, absolutely. You don't know what that's going to change to. They've already changed, the rules on the preservation age, because you used to be able to access your super fund balance if you had retired by, 50, 58. And then based on your age, they've scaled that up, and then to 60 now. So, that sort of changed. The retirement age, I think, for the age pension, that used to be, 65, now that's 67. There's all these things that are changing. And you just don't know 30 years down the line. Like, look at what they've done. They announced the other day, anyone with a balance of 3 mil or over now has to pay tax, or they're proposing this anyway, potentially pay tax at 30% instead of 15%. So that's already going to cost people with a balance that big. That's like they've predicted on average about 80 grand is what it's going to cost people just to have that tax bill, just because some, governments decided to change that rule. So there is a big risk with what's set up now, may not be what happens down the line. And the big thing now with it all is that everything's tax free when you reach retirement and start drawing down all that income. Dividends, all the capital gains, everything's tax free in that environment. Like once you've retired, so you don't want to get to the end of the road there, and then they've changed the rules, and then it's just not viable.
Diversification is so key, right? Like it's building your wealth in super and outside of super. Outside, you've probably got a little bit more control from government regulations, you'd think, but you never know, right? Like they're always chopping and changing, giving you incentives to extract your cash out of your super. Remember that with the COVID? People pulled. We had $20,000 out of their super, and it's like, well, you're actually robbing from your future self just to pay for. I had my wife's friends pulled them out for a personal surgery to make her look better, in one way, which she was beautiful as it is. You need to.
Yeah. My neighbor took out, I think, 10,000 and bought a bunch of surfboards. They just loaded up, and I think they put the numbers out there. They were saying, I can't remember exactly what it was. It might have been like every $5,000 you pull out, or every $10,000 was costing you $130,000 by retirement. Obviously at certain ages and things like that. That was a pretty crazy rule that I doubt we'll see again.
What I'd love for you to, Andy, to poke holes at this ideology or strategy that some people could take is buy property. Like, let's stick with a property thread here. I know you can invest in many other things, but we are a property podcast. So say you're 25 and you're like, all right, I want to retire as quickly as I can, as early as I can. Would you say it's wise to build up some money, savings from work and whatever it is, maybe other smaller investments, to get a property deposit and then purchase a property out of your super in your personal name, and then go and try and buy as many properties as you can in your personal name until, say, you get to like 35, maybe 40-ish, and then start putting more contributions into your super as you get a little bit older, so you can make the money outside the super, and then also that money that you're making outside the super with those property investments, roll some of that into contributions to be able to then start doing it in super? Like, what's the...
Yeah. Oh, look, and this is one of those big, it depends sort of situations again, because, but no, like you're saying, it is something where generally you wouldn't start with the goal being, I'm going to buy a property in my super fund. Most people are kind of focusing on properties in their own names. And building those portfolios outside of things.
There are incentives to do so, right, in your personal name.
Yeah, exactly. Like you get so many tax benefits and things just from investing in property in Australia already. So usually that's, your main or your first goal when it comes to properties, you're looking at it in your personal name. And as you're doing this, if you're working the whole time, super's up to 11% now is what employers are contributing. So, and that's going to keep increasing up until, I think, 12.5% is the goal. So, you've got a good, healthy income coming in from your employer. You're building your super fund in the background, and it doesn't take too long, especially, if your partner's been working the whole time as well, or you've got the 4 to 6 people to be building your portfolio personally, and directing your funds towards that. And then once you've hit those goals, you can look at superannuation in the background, or you can just run them both parallel. You may be able to get away easily with purchasing a property and running that in the self-managed super fund based purely off the rental income and the contributions that come through from your employer as it stands. If you're paying a lot of tax, and then maybe your financial planner or accountant starts working towards different tax strategies, and maybe salary sacrificing is one of those, then, maybe that's going to start that conversation of, right, I'm going to salary sacrifice to get tax benefits personally, and then it's also going to start building my deposit for this property, and we're going to nail that in a couple of years. So it never really, I've never seen it being one or the other. It's usually everyone's focusing on their personal side of things, and then if you want to do it, in the SMSF, that's when you'd start utilizing all the tax rules to try to get as much into the super as you can to get that property.
Cool.
Yeah.
So obviously the pros are, tax-free money when you retire. Are there other pros that you want to add to as well? Like, because you have mentioned the two biggest risks is basically legislation risk and
There is another risk that I would want to touch on, and that's the whole compliance burden. You're managing this all yourself, so there are strict rules that the superannuation, the SIS Act has, which if you breach those as a trustee, there's penalties and fines and things you got to pay. Your fund can become non-compliant, meaning it can't receive contributions. So, that adds to the whole level of risk and adds back to the liquidity risk of, if you're not very good at managing and following the rules of the super fund, you're a bit loose with your transactions because you've got a bank account sitting there. That bank account might just be on your phone. And, maybe you're spending money using the SMSF's bank account and pulling money out. So you're breaching all these different rules. Maybe you're not even realizing it. And then an auditor goes through and picks it all up. And then you get fined. The fund becomes non-compliant. You don't have contributions going towards a loan, and then you default on the loan. So compliance is a big burden there. And it all comes down to record keeping, getting a good understanding of what the laws are, and then sticking within those laws. So they're sort of the main cons with doing this. The other pros, I think we touched on control and flexibility with what you can invest in and what you want to do with the fund, insurances you buy and everything like that. The other pros, obviously you can use leverage, which you can't do in a normal super fund. You can buy the internally geared investments through retail, through ETFs and things like that. But you're not allowed to get any loans otherwise. So with a self-managed super fund, you can obviously do that.
For property investing, you can use finance. Yeah.
What are the interest rate differences from super to personal name for the lenders?
The what, sorry?
The interest rates?
What's the interest rate difference? Sorry, it just cut out.
I think that's what you said,
Yeah. They're not too bad. They're probably around, from what I'm looking at, maybe 0.8% more.
Okay.
Yeah. Just rough ballpark figure, depending on the lenders, now that the space is getting a bit more competitive.
And with that, say, you want to have a buffer of some income in your super fund, right, to pay for, the running of it, the management and all that sort of stuff. Say you've got a property that you've purchased for $500K, and then you want to keep some money there for management, running it, and, also, if you need a little bit more to pay off if say it's like a little bit negatively geared, even slightly, or for maintenance or whatnot for the property, is it worth, can you have that cash in the super fund within an offset account against the loan?
Generally speaking, you can get redraws and offset accounts as normal. There are a lot of restrictions around the loan itself. So the loans in a self-managed super fund are done in what's called a limited recourse borrowing arrangement. So what that means is if you default on your repayments, the bank can only go after the assets that are secured against the loan and nothing else. They can't touch any of the other assets in the super fund. So if you've got a share portfolio and a property there and you default on those repayments, they can only take the property, and then that's it. They can get personal guarantees from all of the members as well on those loans. So, just say there's, stock market dipped. Not stock market, property market dipped. You defaulted on your repayments. Bank goes to take the property. There's still a shortfall there. They can go after the members' personal assets to recover that loan.
If they sign as a guarantor for that.
Yep, and they'll make all the members be guarantors usually.
That's a standard thing when applying.
Yeah, generally speaking, to help limit their risk, because it's only limited to the assets that are secured against that loan. So, and they can't touch anything else in the super fund because they're there purely for your benefit in retirement. So then you have to go down as guarantors against that loan. So that adds a bit of risk there as well.
Biggest takeaway for me on that front would be make sure you're buying an asset that's appreciating in value, and not you're buying those types of assets that don't. So asset selection is really key on that front.
Yeah.
So just before we move on, I really want to get a clear answer on this. I wasn't 100% clear. Can you have an offset account linked to your loan account?
Yeah.
Yeah.
Yeah. And redraw as well.
And redraw, yeah. Got you.
Yeah.
And that will obviously, it's typical offset link. That'll still bring the interest repayments down. So you've got 100K in that offset. It'll still bring interest repayments down by whatever that amount is in, or the loan repayments. Yeah. Okay. Got you.
Actually, now I think about it, I don't think you can actually have redraw. Sorry.
Is that from lenders?
might have to cut that part. Have to cut that part out.
No, we won't cut it out. But is that from? Do you feel that's from lenders, or do you feel that's from?
No, it's the rules around the limited recourse borrowing arrangement, the LRBA, because it's all limited to that one that loan and that security. You're not actually allowed to use equity in that property for any other investments.
Yeah.
So it's all limited to that one loan, that one property. So the way you would normally do it in your personal name, obviously use equity to buy the next property, you're not actually allowed to do that. So if there is equity growing in that property, and just say you've got $100,000 from the price increase going up of usable equity, you're not actually allowed to refinance and draw that money out to use as a deposit for another property or for any other investments. It has to be, any refinance is done, it'll be dollar for dollar.
It's huge because this is a fast way to grow your wealth in property outside of a self-managed super fund, is take equity out of a property that has grown. So you cannot take any equity out in a self-managed super fund. So if you want to buy another property, you have to self-contribute to that self-managed super to purchase another property.
I lost you.
So I was just saying, do you need to self-contribute to a super fund to buy another property?
Yeah, so you can use your contributions or the rental income that the property is generating. Yeah. So you can use the income that it generates from that to build up another deposit, but you can't actually draw money against that property to use on another property.
Hence why Sam's question was really good before around when you're buying in self-managed super, do people typically do in resi or commercial? And with the commercial making more cash flow, that would most likely allow you to grow your property portfolio within a self-managed super fund because you're getting higher cash flow rather than just capital growth, right? Capital growth residential properties, I wouldn't say they're not the go because, high capital growth over 20, 30 years is great for, the growth of your portfolio, but maybe you could scale faster with high cash flow.
Yeah, exactly. Yeah, because you're not restricted to, you don't have to just put your business in what we're chatting about before with that exception. You can buy a commercial property and have that tenanted to anyone as well.
Yeah.
But it's because of that limited recourse, the way it's all looking is, you wouldn't be able to redraw because you're essentially pulling that money back out to use somewhere else. So
yeah, I love it.
Sorry about that.
No, that's great. I think it's awesome to know the difference of cash flow, going for cash flow in a self-managed versus just capital growth, because you really need to know your strategy when you're moving or wanting to grow that.
But you can see, if you've got a lot of members, or you got 4 to 6 members there putting in a lot of contributions, it doesn't take too long to actually turn that around to start looking into a second property or third property and moving down that way. So you do lose the ability to use equity, which slows you down, but you've actually got a lot more income coming into that super fund than you would saving deposit on your own in your personal name.
Yeah, love it.
So key sort of takeaways from this, from my understanding, is if you are thinking about an SMSF purchase, think about diversification, but also what are you looking for? $250,000 in value, really, of your fund to go forward, or anything else that you'd key takeaways for those thinking about it, Andy?
Yeah, just got to make sure that it does fit in with your risk appetite. That'd be the big thing, because I've seen people unwind them because it was just too much for them. The compliance burden compiled with maybe having a bad tenant, or maybe getting a property that needed more repairs and things than they were expecting. Um, it all sounds good or well and good on paper, but when you're actually going through it, it may not be for everyone. So you got to make sure it is within your risk appetite, and you are looking and happy to use leverage and things like that for your super.
Yeah, and a key takeaway for me is to try and find someone who's got accounting mindset and a financial planning strategic background, and then obviously mixing that with mortgage broking. So another key reason why we like to get Andy G on the podcast. another
Yeah.
little for you, mate. But it is really important, and I'm hoping people are starting to understand the importance of good quality advice and talking to the right people.
Yeah, thanks for coming on here, Andy. Really appreciate it.
No worries. Thanks for having me again, guys.